because not all of the opponents to this 0.5%, are opposing for the same reasons. So you have the China skeptics who see it as hugely important that the UK and other Western countries are engaged in developing world affairs. They worry that China, as recent years has shown, will come in and fill that breach if they don't. They see, Boris Johnson has a huge opportunity at the G7 this week to make a stand and project British leadership on multilateral efforts in the developing world. So they see that 0.7% pledge as part of that. Other MPs just object to the idea of the party breaking its manifesto pledge, even though it would hardly be a first time for that. And, then there are others that just want to hold the leaders' feet to the fire and show that the Treasury is going to have to, bend to the will of the backbench. Sometimes it can't always have its way. So there's a mix of motives in there.
Thank you so much, Therese. Raphael there with the very latest, of course, on what's happening in the UK, and then we'll see whether all these big events can actually gather. Therese, Raphael from our Bloomberg Opinion team. Now, let's get straight to the markets because there is quite a lot going on. Remember, it's also ECB week, so watch out for that. That's on Thursday. We have a great Bloomberg story that just hit the terminal saying that the ECB has far worse troubles than inflation. Of course, inflation dominating markets today. If you look at U.S. equity futures, dropping, treasuries dropping, investors weighing inflation risks and the impact of this minimum corporate tax on technology firms. The dollar, though, ticking higher. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me from Berlin. Our Elise Abramovitz actually joins us from New York. We'll have a full roundup of this resurgent inflation, again, sparking this debate about when the Federal Reserve will start tapering monetary accommodation. This is Bloomberg.
Announcing a project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. Now a base to show use cases, so we can develop new cases on how to build a hydrogen economy.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is progress, historic progress. Progress that's pulling our economy out of the worst crisis it's been in 100 years.
This is a positive report. Certainly, I would love to be able to stand here and say 7 million jobs came back, but unfortunately, that's not how the economy works.
There's no, hardwired deadline. We are doing the work of legislating. This is a big leap.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Monday, June the 7th. Our top stories today are higher interest rates on the way. Well, Janet Yellen says they would be a plus for society and the Federal Reserve. Targeting the tech giants, the G7 agrees to impose a minimum tax on multinationals like Facebook and Amazon, but the agreement could take years to implement. And crypto's getting crunched, while Bitcoin and other top digital currencies fall on concerns that there may be another crackdown in China. Well, good morning, everyone. Happy Monday. I'm Francine Lacqua with Matt Miller and Lisa Abramowitz. Keely Lines is off today. Now let's get straight to the markets. It's all about inflation and taxes. Matt, what are you looking at?
Yeah, absolutely. I mean, there's a huge central bank focus today, Francine, but the tax issue is moving a lot of markets. Take a look at what's going on in Asia, for example. We have a big drag on the MSCI Asia Pacific and on really Hong Kong's HSI index, and that is 10 cent, really pulling down, and any of the big digital, global corporations that could be hit by this global minimum tax, even if it takes years. You've got some areas of Asia not doing much at all, some areas doing well. Singapore, for example, is looking at some gains right now. But look at the bottom of this chart, 10 cent down 1.8%. It's a very heavy stock. So 10 cent is a huge drag, but you're also seeing Alibaba and other big digital corporations getting hit by this concern. In Europe, we have a different concern, and that is a delay of the reopening. If you take a look at the indexes, there's not a lot of movement. Here you can see from the world map that we have a lot of gray on the map. So that means not a lot of movement to the upside or to the downside. But you do see individual companies, for example, IWG, right at the bottom of this chart. And a lot of people won't know IWG by the holding company name, but they operate Regis and other flexible workspaces. As a result, they are down big time. They said the reopening isn't happening quickly enough, and they get almost half of their revenue from the U.S. They're traded in London, of course, and they have a lot of office space in Europe and in the UK, but they're saying, look, the delay is taking longer than we had anticipated. It's going to push out a rebound in revenue, and that is a real problem, a real concern across markets. Lisa, what are you seeing in the U.S.?
Not a lot, which is, I actually think, very interesting. The idea here being that people are expecting there to be some sort of decline in the big tech names as a result of the tax agreement. You are not necessarily seeing that. I find that interesting, Matt. If you take a look at what we're seeing across the board, we can see that it's down a little bit. The S&P is down about 0.1%. Not significant if you consider the incredible potential for these tech companies to get taxed. Also, you're seeing a bit of a reversal from what we saw on Friday after that disappointing jobs report, a little bit of a bleed higher in yields, in 10-year yields. Also interesting, crude coming off its highest levels since October 2018. This expectation that perhaps demand isn't as hot as people expected. My key question is, how quickly can U.S. supply come back online? OPEC Plus saying it has the upper hand and can take control. The question is, can it really? And Bitcoin, a volatile weekend session, as it is wont to do. There was a question of China cracking down Weibo on the social media platform, talking about possibly removing or banning certain sites. They do not want another Elon Musk over in Chinese social media whipsawing this currency. However, we seem to have found some stability, Matt. Fran, what are we looking at this week ahead?
Yeah, Bitcoin is definitely the big one. You know, steady at 36,000 after the pretty crazy roller coaster ride that we saw in the last 10 days. Now, these are some of the events that we'll be watching out for in the week ahead. Apple holds its annual Worldwide Developers Conference today to announce new hardware and software. Then the World Trade Organization meets tomorrow to discuss expanding the production of COVID vaccine facilities. We'll also get a Bank of Canada rate decision on Wednesday, followed by an ECB rate decision on Thursday. And of course, the big one, the G7 Leader Summit starts in Cornwall, England on Friday. And as Lisa was saying, it's interesting to see not that much is changing on the markets despite this historic deal on, of course, tax that could take years to put in place. Now, Treasury Secretary Janet Yellen has also weighed in on the inflation debate. In an interview with Bloomberg, Yellen said that if President Biden's spending plans lead to slightly higher interest rates, it would, quote, actually be a plus for society's point of view and the Fed's point of view. Now, let's get more from our Bloomberg MLive editor, Eddie van der Walt. Eddie, he's back, and he's looking at inflation. The concern, Eddie, is that actually it's confusing because, you know, usually finance ministers don't weigh in on central bank matters.
Absolutely, absolutely. But you know what? I think she makes a really good point here. I think most central bankers would like to see interest rates a little bit higher. They'd like to see inflation a little bit faster. They'd like to see a normalization. And I think some of that, you know, it's true also in Europe. We haven't got a strong voice like Yellen, perhaps, you know, outside of the ECB saying it. But I think it would be a positive, and the European banks are clamoring for it. Now, European banks today are slightly higher, and it is on this expectation of inflation rising and a steeper yield curve, which benefits them because, of course, they lend at the long, you know, at the long end, and they borrow at the short end. So that's really interesting dynamic, and I think she's absolutely nailed it on the head. Whether we get to see that, you know, in the months coming up, that's another question altogether.
What do you think about Bitcoin? Is $36,000 the new normal?
I tell you what, Matt. If we stabilize here, right, below at 36, after that run that we had last year, it would be a significantly different story than we had in 2016, 2017, when we had a parabolic rise and then a crash by 80% or more. We're less than half below the most recent peak. So if we can stabilize here, Bitcoin remains an extremely volatile asset, but it just shows that the volatility over time is starting to abate. But we're not quite out of the woods yet. So let's give it a few more months and see.
Eddie van der Walt, thank you so much for all of your coverage on this. Meanwhile, over the weekend, the key news really was that G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. A landmark deal. It may help countries collect more revenues from big digital firms. UK Chancellor Rishi Sunak hailed the agreement.
I think the crucial thing for people to take away is the principle of fairness. That's what we've achieved today, to ensure that there's a level playing field for all types of companies. And whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
Bloomberg's Maria Tadeo in Brussels has been covering all of this. Maria, what are the details here?
Well, you know, this is something that is being hailed as this tax revolution, as this new tax system for the 21st century. You heard it there. This is about paying a fair amount and a level playing field. So we do have a deal on two fronts. One, of course, is on the rate. That's 15%. And the other one is this principle that would now allow countries to tax digital companies in the place where they make and provide their services. Now, a lot of the criticism had been for years that they were flipping profits to low tax jurisdictions. So this should put an end respond to that. The problem here is the implementation, and the implementation risks are still very high. You know, we're talking about the G7, but then this needs to go to the G20. We'll also have to go to the OECD. At the same time, you could see that there will be countries such as the Irish who would push back against this because they're very competitive on the tax. And also from a legal perspective, it could take years for it to be applied. So it sounds great on paper, but the implementation risk around it are still very high.
Yes, so Maria, this could take years, and at the same time, it could actually, you know, not go beyond the G7. So what does it mean for these big tech firms? Have they even weighed in on the debate?
Yes, Francine, and you know, they did so very quickly and perhaps more positively than we were expecting. Of course, no company likes to pay more taxes, but to some extent, this is a long time coming for digital companies. They've known for a while, particularly in Europe, the governments would want them to pay more and want to pay more nationally. So they did say and commented that this is a good deal if it means there will be a clear tax system and that those tax rates will be clear across the world. For them, it's better to pay just one amount than many different national regimes. So that's the upside for a digital company like this, even if that bill could go up.
Bloomberg's Maria Tadea, thank you so much for all of the reporting. Let's take a look at some of the stocks that are moving in pre-market trading in the United States. I want to take a look at AMC. Interesting to see it's up 4% in pre-market trading here, and this comes as the Russell 2000 thinks about possibly kicking it out of that index, bringing it up to the Russell 1000 because it's gotten so big. I am interested to see how this affects the composition and really how this affects the discussion around the meme stocks and their effect, shall I say, on some of the index stocks. Next up, Tesla, one of the Bitcoin proxies, which has been whipped around. Also some concerns about longer-term production. Tesla definitely becoming and acting increasingly like a crypto asset, down 1.7%. The key question is how volatile it will get throughout the session or whether people are actually just increasingly using it as a mainstay. And then last but not least, we are definitely interested in watching Apple. This is as the Worldwide Developer Conference kicks off, but also as a number of people have been talking about, potentially one of the companies most affected by the minimum tax rate throughout the world. We're not seeing that big of an effect on the price. I find this interesting, Fran. Basically, we've had this potential for some of these companies to see tax rates surge by significant margins. Very little action in the stocks. What's that telling us? To me, anyway, Fran, that's saying that people don't buy that this is actually going to go through as proposed and potentially could take some steam out of President Biden's wish to get the tax rate up to 28%.
Yeah, I spoke to Sir Howard Davies, of course, the chairman of NatWest Group, and Lisa, he was saying that, look, this could take years, and it's very difficult to see this going beyond the G7. So I guess what we'll see in the next couple of months if it does get more traction or not. Now, coming up, we'll talk taxes and inflation with Freddie Late, Latitude Investment Founder and Chief Investment Officer. And then a little bit later, we also speak to the new OECD Secretary General. He's Matthias Cormann. That's at 7:30 a.m. in New York, 12:30 p.m. in London, and this is Bloomberg.
G7 has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
That was U.S. Treasury Secretary Janet Yellen speaking on the G7's landmark tax agreement. Joining us now is Freddie Lade. He is CIO and founder at Latitude Investment Management. And Freddie, you know, a number of your top 10 holdings, I'm thinking about Google, and I think it makes up almost 5% of your fund, could be meaningfully affected by this change if it is ever agreed and enacted on a wider scale, of course. What's your view on a global minimum tax?
I think anything that simplifies tax on a global basis is probably a positive. But as someone said on the show earlier, no corporations like paying higher levels of tax. But to a degree, a simplification of business and being able to make business decisions around operating performance and likelihood of growth rather than tax regime is probably a positive for building out businesses that are established and those in the future. And I think, you know, the reason why we're not so concerned about some of those stocks like Google and Alphabet, is that, you know, this is a meaningful impact. If their tax rate went up to 15%, it would be, you know, a 10% hit to all future earnings, whatever, something like that. But it's probably going to come in a few years' time. We're not even sure if it's going to be beyond the G7 at present. There are probably some other things to mitigate it, and we still believe the businesses are undervalued. So I don't expect a huge share price performance move on the back of it.
We do see at least knee-jerk reactions in Asian stocks today. I noted earlier that Tencent, for example, is taking a 2% hit today. It's not, you know, massive, but they're a very big company. In terms of the other big holdings in your fund, you have, you know, huge multinational corporations, but not so digital in nature. You have Coca-Cola, for example. You have Sony, Diageo, Heineken. Is this only going to, are investors only going to worry about the internet platform companies here, or is it all global corporations that we should be watching closely?
I think it'll apply to all, but there will obviously be some where it's a positive as well. I mean, you know, even businesses like Coca-Cola have had a tax issue, so they've had issues with where they've been booking profits, and there's a sort of amount held on their balance sheets at the moment for a large settlement that's going through with them because they're effectively becoming more and more of an IP and advertising business, and the actual manufacturing being pushed out to the bottlers. So it's hard to know where they generate those profits, and actually making it a level playing field so you can distribute your team internationally, your global team of development, R&D, innovation, and marketing, knowing that you're going to be taxed on a fair basis, I think would allow you to scale and move the innovation around the world in a truly global business like Coke in a much more positive way over the next few years. So I don't see it as a negative for them. I think given the lower tax rates that are found in the digital businesses and the fact that there's so much arbitrage which has been going on with where you've booked revenue versus IP and things like that, they are going to be the most affected. But it doesn't surprise me that Tencent's down sort of 2, not 10% today. You know, a tiny bit taken off the value, but not a huge amount in the grand scheme of things.
Freddie, overall, we had a pretty good earnings season, but how much pressure are we going to see on margins going forward?
Yeah, we've had an incredible earnings season. I mean, you know, businesses that were already doing well have sort of upgraded earnings estimates for the next few years by sort of 10, 15%, certainly many of the names that we're invested in. And I think, you know, that was a surprise to some. It was the scale of it was a surprise to us too. But every call we've listened to for the last few months, they've talked about input cost inflation. And I think margins will therefore be a function of, you know, we know input costs are rising, whether that's wages, distribution, underlying products, raw materials, commodities. It's your pricing power on the other side. So, you know, margin is obviously the difference between the two. And I think focusing on those businesses, which we always do through cycle, whether there's inflation or not, where you believe they have the power to reprice the end customer, whether that's a consumer or another corporate customer, to take into account that input cost inflation. I think those businesses will survive and thrive in this environment. And those that get their margin squeezed could see a really difficult period of stock derating, volatile earnings, and becoming kind of trades around commodity or input cost proxies as opposed to the underlying operating performance.
Freddie,
so I think it'll be a tale of two halves. Sorry.
How does that look? No worries. How does that look in terms of the performance? I mean, does this just mean that some of the companies with less pricing power underperform, or does it mean that there's actually a drawdown in markets and that the companies that you're going toward are kind of the safe havens within equities?
So there's a lot to unpick in that question. I think it will drive margins lower, probably in aggregate, and it's therefore very important to buy into those businesses where you believe that the margins can be held or increased from here, and that generally is a pricing power and sort of position in your industry argument. There is also a meaningful risk that if inflation and interest rate threats or even threats of interest rates comes back, that the whole market takes a hit and derates downwards. And I think that is probably the greatest risk to investors at the moment. And to the third part of your question, does that mean you hide, if you like, in the safe havens, which maybe you can't balance off those two risks, because there's one risk of margin, pressure, and some very high quality pricing power businesses are out there, but they trade at very high multiples. And so you're at risk of the second impact, the second order impact of inflation. And so we believe actually you need to be looking at very high quality cyclical businesses and some of the more value stocks out there, which we would argue really truly can be as high quality as these defensive businesses, but come at literally a fraction of the valuation to get your portfolio valuation down to a level which you feel makes it far less susceptible to that second risk.
Freddie, thanks so much. Freddie Late, their Chief Investment Officer and founder at Latitude Investment. Now, coming up on Balance of Power, Ray McGuire, former city vice chairman and New York City mayoral election candidate. He'll have a thing or two to say about buses, transport, and, of course, climate change. That's at 12:30 p.m. in New York, 5:30 p.m. in London, and this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman, London, Matt Miller in Berlin, Lisa Abramovitz in New York, Kaylee Lyons is off today. Now let's get straight to the Bloomberg First Word News. And in China, the trade boom continued last month. Exports grew almost 28% in dollar terms from a year earlier. Now that's weaker than forecast and below the pace in April, but it's still well above historical growth rates. Meanwhile, imports soared 51%, boosted by rising commodity prices. Now in Germany, Armin Laschet has boosted his chances of succeeding Angela Merkel as chancellor. In the final electoral contest before September's national election, Laschet guided the Christian Democrat to victory in the country's poorest state, Saxony-Anhalt. Well, the outcome will help ease doubts about his suitability to lead Germany's conservatives. And in Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress. A survey, though, indicates his coalition won't retain a supermajority needed to pass the constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiichi Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of a jailed former president, Alberto Fujimori. And it would be one of the biggest leveraged buyouts of all time. A consortium of private equity firms reached an agreement to buy medical supply company Medline Industries. Well, Bloomberg's learned that the transaction is valued at more than $30 billion. The consortium include Blackstone Group, Carlyle Group, and Hellman & Friedman. Proceeds will flow to the Mills family, who will keep their leadership roles at the company. And Matt, you alerted me actually to the story as soon as I came in. It's one of our most read stories because the Mills, I didn't know who they were actually, and it wasn't obvious that they're one of America's richest families.
Yeah, and I was kind of hoping, like, someday I'll find out that my family has a business that I didn't realize we had, and it makes us into instant overnight billionaires. It's kind of been a pipe dream of mine.
What was interesting to me about this story, Fran, was the idea that this is the company that made the swaddling blankets that are ubiquitous across America. The sort of striped
I
ones.
love those.
I didn't know that.
Very important.
I didn't know either.
Fun
and I didn't know they were worth $30 billion. Coming up, Mathieu Savary, BCA Research Chief Strategist. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều những cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Lisa Abramovitz in New York. Katie Lyons is off today. Matt, a lot of the focus, of course, is on, that inflation that will spark debate with Janet Yellen once again talking about interest rates and what would help the Fed or not. I had an interesting conversation with Sir Howard Davies saying the messaging from the U.S. right now is just confusing.
Yeah, well, and we saw an interesting piece by Bill Dudley saying that it's dangerous to the economy because it's not only the inflation target that they've set, but they've also pointed out that they're going to keep rates at a low until unemployment is back down. And all of these things together could cause massive volatility when they have to turn around and raise rates further. The question, though, the basic question still is whether or not this inflation is transient, right? Do you believe it's transient, right, or are some of the price increases here to stay?
Right, and that's been the debate over the last couple of months. And Lisa, that's obviously playing out in the markets, but they're still confused, I guess, the markets about how to price in this tax increases.
Well, Francine, this is where I wanted to go. This idea that we're getting such huge potential changes, yet such little drama in markets. And this has been a theme for the past number of weeks. The idea that we've gotten, proclamations from key officials. We could see runaway inflation. We could see policy errors. We could see higher tax rates. We could see huge fiscal stimulus. Markets, no drama. If you take a look at what's going on in markets globally, you are seeing a bit of a sell-off reverse. Now all of 0.01% increase in the Stocks Europe 600. This idea of no drama is pervasive, even with the tax proposals. Yes, you're seeing tech names lead the way down in the United States ahead of the open, and yet not very much, leaving the S&P futures down just 0.25%. Meanwhile, 10-year yields ticking up just a little after that decline that we saw on Friday after a disappointing payrolls report. People wondering how much inflation could potentially key up given the potential for a policy error like Bill Dudley was saying, as Matt mentioned. And then Bitcoin down now 2.1%. Check us back in a half an hour. It might be completely different, Matt.
I think it is pretty dramatic, though, Lisa, that Bitcoin trades for $36,000. I mean, even though it's down from an earlier high, it's still an asset that, was going for $3,000 a couple of years ago and $3,000 a few years before that.
We know you got in on the bottom. Congratulations. You won this one. And you're right, $36,000 looks pretty good if you got in at $3,000.
I was just also thinking.
Password.
Yes, I wish. If I could remember its password, my password, I would have a Lamborghini Aventador. I want to point out something right now. Aventadors have gotten a lot more expensive recently, as have many other goods. We're looking at the surge in U.S. inflation here, and for those of you listening on London DAB Digital Radio, we welcome you. I'll walk you through this chart. What it shows is PCE, core PCE, so minus food and fuel, but including Lamborghinis, going back to the 90s. We're looking at the kind of spike right now that we haven't seen anywhere else on this chart over the last year. Core PCE has just shot up, and it's also up to the highest level that we've seen since 1991. That was the year that I dropped out of high school. So it's been a long time since we've seen these levels. You also have here the Fed funds target, and it just flatlines over the last 2 years, obviously during the pandemic, at a low of between 0.25%. So it's interesting to see core PCE spike like this and nothing happen, Fran, on Fed rates.
Yeah, I think, Matt, you're much younger than you let on. Now, higher interest rates could be a plus for the U.S., according to Treasury Secretary Janet Yellen. Earlier, we spoke with NatWest Chairman Sir Howard Davies about his view on the inflation debate.
I think the US are being a bit confusing here. And I think it would be good if we heard one message from the US, because on the one hand, you've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing. And as a banker, I could hardly disagree with that. That would actually be quite positive from a bank's point of view. On the other hand, you've got the Fed saying, well, we are going in future to adopt an average inflation approach. It's not the same as what Janet Yellen is saying, because what the Fed are saying is we may not raise rates and allow inflation to be higher than the target for a period. Whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
Well, joining us now is Mathieu Savary. He's Chief Strategist at BCA Research. Mathieu, thank you so much for joining us. When you look at the European Central Bank and also some of your calls on European assets, do they have bigger fish to fry than the inflation debate?
Thank you very much for having me this morning. Yes, indeed, you're absolutely correct. They do. Right now, there is still a lot of uncertainty regarding the European economy. We're seeing a nice uptick taking place because the global economy is strong, because the vaccination campaign has picked up considerably in Europe. But nonetheless, we still don't know exactly how fast the European economy will reopen in the second half of the year. And moreover, the ECB is conducting its strategic review right now, which means that there is really no urgency until this is conducted to adjust policy right now and weigh into that inflation debate for now.
So, Mathieu, why do you like European assets right now? For a long time, or for most of 2020, they were kind of on the back foot.
Well, there is a multitude of reasons. The first one is simply the fact that despite this uncertainty right now, the stars have lined up quite well in favor of the European economy. There is still a lot of pent-up demand in this economy, and the eventual reopening will definitely boost economic activity in Europe, which will have a positive impact on domestic play within European assets. And secondly, the general environment, which continue to favor higher yield over the next 12 to 18 months, which continues to point toward a lower US dollar and higher commodity prices, is consistent with a further outperformance of value stocks relative to growth stocks, and particularly sectors like industrials, materials, energy, and to a certain extent financials. And Europe overweighs those sectors compared to the United States. So from a sectoral perspective, Europe is well positioned. Finally, in a context of a depreciating US dollar, the euro looks good.
You talk about the risks to your thesis, and the one I find really interesting, Mathieu, is a potential deterioration in the global credit impulse. What exactly do you mean by that, and how could that be brought on?
Okay, so it's actually the credit impulse is the change in credit flows, because ultimately what matters the most for economic activity is just that. It's not just the stock of GDP, it's not even credit flows per se, but what will determine growth from one year to the next is how much those credit flows are changing. And last year we did see a pretty strong pickup in credit flows as companies around the world in particular geared up for potential period of illiquidity and essentially borrowed a lot of money. Now, what we are seeing is that the credit flows have stabilized, which means that the credit impulse has deteriorated massively. In fact, very near-term credit impulses are quite negative. Then there's the Chinese economy. We know that Beijing is trying to protect essentially financial risk in that economy. And we've seen a sharp deceleration in credit growth and in the Chinese credit impulse, which historically brings about a strong deterioration in industrial activity and global trade. There is reasons this time to think that the deterioration in global trade will be smaller than normal because there's so much fiscal stimulus in the system. But nonetheless, this lineup of factors suggests that we could see this deterioration in the credit impulse. So this is worrisome because historically it tends to indicate a period where the cyclical spending in the economy, which is financed using credit, tends to deteriorate a little bit. And since Europe is an economy very sensitive to the global industrial cycle, to global cyclical spending, at the end of the day, it exports a lot of machinery, cars, chemicals, and things like that. If this deterioration in the credit impulse really starts to drag down the global economy with it, then European assets, which are very sensitive to global growth, will underperform in that context.
Mathieu, I'm looking, for example, at some data coming out of Europe. Germany in particular, you saw factory orders drop 0.2%. The expectation had been for an increase of 0.5% in data that came out this morning. At what point do you take a look at this data and get concerned versus discounting it as simply noise amid a reopening?
Well, for the time being, when we look at, for example, the surprise index for Europe, it's been quite strong. The aggregate of the data has turned around, and a lot of the data that continue to perform poorly is more backward-looking. When we look at things like the PMIs, the confidence data that, yes, are soft data, but have a much better track record as a leading indicator of economic activity, they are doing very well right now in Europe. So that's what I tend to focus on. But if I were to see a sharp deterioration in new orders to inventories and things like that in Europe, I would get very worried.
Mathieu, thanks so much. Mathieu Savary, their chief strategist at BCA Research, joining us this morning. Now, coming up, consensus on crypto. Well, we'll discuss the role of digital coins after more than a decade of Bitcoin's existence. That's coming up next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you're looking for a safe haven, I see Bitcoin as the most secure, most reliable, most certain thing in the entire economic universe, and if you're looking for some place where you can store your life force or your economic energy, you know, there's no real question.
A fun fact, there's 46 million millionaires on the planet. It's only 21 million Bitcoins, so they won't own a Bitcoin. So if you own a Bitcoin today, you will be a millionaire in the future, for sure. Congratulations.
Everything about it is why we're into it. There's nothing else that compares to it. And we have no interest other than making sure that we are building a native currency for the internet and helping in every way that we can. So all the other current coins, to me, don't factor in at all.
That was Jack Dorsey showing off his latest T-shirt favorings. Right now, we have been looking at some of the biggest names in cryptocurrency, discussing the potential of digital tokens at this turbulent moment. We'll get a state of play for cryptocurrencies with Bloomberg's Joe Weisenthal, anchor of What Did You Miss on Bloomberg TV. Joe, you did a column on crypto out today, and you had a really interesting idea here that we actually have some consensus about what Bitcoin is. Can you explain?
Yeah, I mean, you kind of heard them talk about it right there, this idea of like a safe haven asset. For years, there's been debate, is it a currency, is it a commodity? People, oh, why don't people spend it? Oh, that's a sign it's not really used. That kind of debate's over. Like, people don't really talk about that anymore. There's like this weird consensus that's emerged that it's like kind of like digital gold or something. But in the piece that I wrote out today, it's basically saying like, okay, with that consensus that's emerged for Bitcoin, other things have emerged that are really trying to be something extremely different, and there's quite a diversity now within the crypto world.
Joe, one of my favorite things about your column is the incredible meme art that you quote and how much this has become popularized. How do we know, though? Fine, great, we get it that we definitely have some consensus on what Bitcoin is. When will we have a sense of its staying power? Is it regulatory scrutiny, as we see on an ongoing basis from China?
Yeah, I mean, look, I think there's always going to be probably an evolving regulatory landscape. By and large, I think actually I would say people have been quite surprised at its acceptance. People are like, oh, they're going to ban Bitcoin, or there's going to, you know, some things out of China. But look, take a look at the U.S. Like, it gets more and more accepted as a thing. Every year, it's getting more entrenched on the financial system. We have the Coinbase IPO. We have institutional vehicles to invest in it. So despite years of like sort of assumptions, I would say that some big crackdown is coming, and who knows, the actual facts on the ground seem to have been the opposite.
I love, Joe, some of the very absurd but cool memes that you have in the story. So congratulations on finding them and actually reprinting them. Joe, I mean, regulation, we still don't really know how much of this is money laundering and things like that. So if regulation comes, I mean, could it actually change the way that, you know, Bitcoin is? And does it, you know, does something else like Ethereum take over? Or is it still always going to be there?
Well, that's the thing. I mean, I think if you look at some of these other visions for crypto that are emerging, and you hear a lot about so-called DeFi, decentralized finance, many of these things are perhaps more aggressively trying to, I don't know, taunt or pose a problem for regulators. I mean, there are places you can go now to trade de facto swaps and synthetic equity without any sort of KYC, AML, things that resemble more traditional finance instruments very directly, things that are pegged to existing equity, things that resemble IPOs and things like that, platforms that resemble stock markets. And so I think that like the regulatory landscape for altcoins is going to be very interesting, pose novel challenges as people attempt to define what these assets are. But I think we're sort of at the beginning of this, and so far we don't really know what the overall regulatory response is going to crypto writ large, what that's going to look like. The meme, is the main meme modern monetary theory? Is that what it was called in your column? Oh, no, Magic Internet Money Wizard, which is kind of the same thing, right?
Yes.
As modern monetary theory. You talk about Bitcoin being backed by nothing, and it reminds me of the U.S. dollar, although I suppose the global oil complex is what backs the dollar.
Well, I mean, also there's a requirement to use the dollar. And even in the United States, I mean, if you want to pay taxes, and this is a really key point, which is that
you know, you have to pay taxes in dollars. So you and I could transact in any currency we wanted over the course of a year, but at the end of the day, I have to pay a tax bill in dollars, so I have to go out and acquire dollars, and that creates a demand for them. What's even more extraordinary about Bitcoin, perhaps, is that there is no requirement, there's no obligation to use it for anything. And so, like, you know, when we talk about a meme coin, for example, we're like, all right, everyone thinks about Dogecoin or something like that. But my point is, like, Bitcoin is fundamentally not that different. It's just that the meme is digital gold or the digital money. It's a very powerful one. But really, I mean, it's become, I guess, this, like, you know, over $500 billion asset, basically based on belief. Some people believe that it's a valuable thing. Some people think that it's a safe haven asset. Some people think that space within the Bitcoin blockchain is a valuable thing. And, you know, there's no use case really for it other than expressing that belief by holding it.
I mean, come talk to me next time your pipeline is being held ransom, Joe, when you think that you aren't required to redeem Bitcoin for anything.
There's something
in terms of the institutional uptake, I mean, we just heard some big names and really, to be honest, some meme-ish names talking about Bitcoin. But it does look like Wall Street is really embracing it as a store of value. I guess that's what your whole column is about. What are the differences between Bitcoin and gold, other than, you know, the physical property of the latter?
Well, I mean, I think part of it is like, okay, so what constitutes a safe haven? And I think historically people have viewed gold as some sort of protection against inflation, or maybe a protection of negative real interest rates, which is how it trades more recently. You know, I think like Bitcoin's safe haven properties potentially are different. One of the, you know, positives, or one of the sort of things that Bitcoin offers someone, is the ability to transact freely. So I can send it to you, you can send it to me without some third-party government or business saying that we're not allowed because maybe they don't like us. And so I think that there is an element of sort of like protection against sort of free money, so to speak, where it's not so much about the central bank per se, although that's obviously a lot of what attracts people to it, but the idea of authorities saying who can and who can't use the money system, which is a sort of increasing threat, you know, in a digital world. Perhaps Bitcoin offers a distinction from gold in that respect.
Bloomberg's Joe Weisenthal, thank you so much for being with us. It's a great column. Everyone, I recommend you read it. Coming up, we'll continue the conversation on Bitcoin, talking to Skybridge Capital Co-Chief Investment Officer Troy Gajewski about why he expects crypto to rally in the next year. He has a significant position in it. He has had this position for a while. That's at 7 a.m. in New York, 12 p.m. in London, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Well, this is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London. Matt Miller in Berlin. Katie Lyons is off today. We're also joined by Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, you have the very first interview with the new Secretary General of the OECD, and it's perfect after the tax deal.
Well, after the tax deal, it really rings true. And this is a very different new OECD Secretary General. Francine, you and I have spent a lot of time with Angel Gurria, esteemed economist, esteemed gentleman from Mexico. Matthias Cormann is Belgian, and he's from Australia. He's from Western Australia in Perth, and he is a finance guy at heart, a really interesting resume. I'm dazzled that the OECD selected Mr. Cormann to provide leadership, and really looking forward to that interview. One of the backdrops he has, besides a new tax deal, we'll touch on that, as Greg Valliere says this morning, Francine, it's a treaty, get over it, and that's a huge hurdle in the United States. Is the inflation surprise? Just quickly here, as we've known from the economic data over the last number of days, the inflation surprise index is up, up, up.
Yeah, and I know you have a great chart, which I'm looking forward to hearing more about. Tom Keene there, co-anchor of Bloomberg Surveillance. Matt, we also have a busy day. I'm watching the Apple conference. What are you watching?
Well, you know, I'm watching the possibility, and this is one of the most read stories in the UK, that the reopening is reclosed again. You know, just as everyone seems confident that we're getting past this thing, we're seeing a resurgence of cases in the United Kingdom, and that could lead to lockdowns coming back. Which would be a huge problem. I don't think it's really on anyone's radar, and all of a sudden, it's a threat.
Yeah, I'm losing my voice because there was so much anticipation about, events, unlimited people at events reopening. I think, Matt, I mean, certainly here in the UK, people are, instead of expecting a lockdown, maybe of easing slower than expected, or slowlier, that's not even an English word, than expected. I'm also looking at the Apple, boosting its iPad features and privacy tools at the developer event. So it'll be interesting to see what exactly they have in store for us. That's a little bit later today. Now, coming up in the next hour, Bruce Kasman, JP Morgan chief economist and head of global economic research. That's coming up shortly, and this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
It's hard to have much of an inflation problem if wages are still quite quiescent.
We're recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The market's a little too complacent about the Fed not even talking about tapering.
We are still awash with excess liquidity, and that helps to support a lot of valuations.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene is simulcast. Bloomberg Radio, good morning. Bloomberg Television, good morning. On a Monday, Matthew Miller in for John Farrow this morning. Lisa, I look at the screen, I look at the jobs report. We got all this policy stuff going on. You know what? The 10-year yield, 1.57 handle. No one expected that.
Well, to me, this is the fascinating thing. We're actually getting so many developments, whether it's on the potential tax fronts or whether it's on whether the Fed will or will not taper. And you're seeing nothing in markets. I mean, for all intents and purposes, it's a no-drama Monday. Sleepy Monday.
It's a no-drama Monday. Yeah, go, Lisa, I'm going to go with that because a no-drama Monday signifies nothing's going to get done. There's a huge belief in the market that a lot of this is noise. We'll dive into it through this day, through this week as well. But Lisa, I look at where the yield is and where the yield is, real yield is, which is unchanged. What a story from where we were 1 week or 1 month ago.
The idea here, especially because of the Friday jobs report, is that perhaps the Fed is correct, right? They have it under control. My question is, if you look at some of the underlying data, you can see wage pressure starting to increase, particularly in the industrial side. What happens if you get an increase in inflation and yet we don't see material improvements in some of the headline labor market metrics? What does the Fed do then? And I think that increasingly that's going to be a conundrum people are going to try to address.
It's going to be really interesting to see. And, you know, Greg Villiers already out with an exceptionally sharp note this morning, which I think really underscores the stasis that's out there. Europe has its own stasis. Matt Miller, I'm thrilled you're with us because to me, Europe is fascinating. Forget about the mess in the United Kingdom with the virus, which you beautifully underscored in the last 20 minutes. In Europe, is it essentially thumb up into the summer or thumb down?
Well, it looks like thumb up. In fact, we're all reopening at a pretty decent pace, and inflation is coming back to some extent. In fact, on Thursday, we're going to have an ECB meeting, and everyone expects the central bank, Madame Lagarde, to raise their inflation targets again. They're already expecting 1.2% this year, 1.5% this year. That sounds like not very much from where you're sitting, but for us, it's a dream come true. The question is, can they keep it going? Can we continue to reopen at this pace?
The reopening that we're seeing is really spread out around the country. And again, we'll have the OECD Secretary General with us, with his Australia being particularly challenged. Matt, help me with data right now. We got futures -8, Dow futures -4, and the VIX 17.13. Matt Miller, what do you see?
Well, I'm watching the currencies pretty closely here. Look at the euro right there. At 121.59, we're getting pretty close to some of the support levels that the analysts I talked to are watching. So we continue to drop down, which is interesting because you expect that the ECB gets a little bit more hawkish at its next meeting and maybe starts to change some language. You could see a turnaround there. The 10-year yield you already talked about. Forget about the magnetism of 162. That's dead and gone. And we see that across bonds here in Europe as well. German yields climbing up to less than 20 basis points of negative yield, although we're still negative across the spectrum, really, all the way out to 2 years, even in Greece and Italy. And I see NYMEX crude right now coming down a little, but still at $70 a barrel, almost $70 a barrel for NYMEX crude. That looks like a Brent quote.
Yeah, and gold at 1886. Brent crude 71.48 with a 72 print earlier last week. I should know Bitcoin 36,000. Michael McGlone, tough duty. Miller's like struggling in Berlin. Abramowitz is lost in the Adirondacks, and Michael McGlone of Bloomberg Intelligence in Miami, being very Bitcoin. Somehow I know Mark Gurman, Lisa, today will be looking at the Apple conference.
Yeah, this is what a lot of people are watching today because, frankly, there's not a lot else happening today. Let's just be honest. Apple kicks off its Worldwide Developers Conference. They potentially could announce a new iPad Pro. Tom, you can get this for a vet bill as well as Afterthought and all the rest of the family so they can leave it under the couch. Basically,
already ordered the new one.
I'm sure you have.
Orange is our chosen color.
I'm sure you have. It can join all of the AirPods that are also under the couch. There is a question here about what Apple can introduce that can keep the momentum going. Interestingly, you see the shares down 0.6% in pre-market trading. This is not because of the developers conference. This is because ostensibly of the tax agreement by the G7 leaders. Question is, though, why is not down more considering the potential consequence to its balance sheet, something we'll be discussing throughout the morning. Today, President Biden will be meeting again with Senator Shelley Moore Capito, who has been really spearheading the Republican effort. This is yet another meeting. This actually, interestingly enough, Terry Haynes of Pangea Policy came out and said this is actually positive for the prospects of getting a deal done because there is no deadline. This can continue to be negotiated. He puts the chances of a deal getting done at about $1.25 to $1.5 trillion at about 60%. I love that he comes out with percentages. Also today, I love this story because it really highlights where we are in the COVID fight. Teens, the age of 12 to 15, can actually start getting vaccinated in Germany. They just approved the Pfizer-BioNTech vaccine for younger teens. We're seeing a massive decline in the number of infections, Tom, across the globe, about the lowest in 3 months globally. In the United States, the lowest level of infections since March 2020, excuse me. We are getting ahead of this. And the question is whether the data can catch up quickly enough.
Very good. Nice briefing there, and particularly on the good news on the pandemic worldwide. There are some challenging lockdowns here and there, but all in all, very constructive. We're thrilled to start strong this week with Bruce Kasman. He's with J.P. Morgan, their chief economist, head of global economic research. He herds the cats at J.P. Morgan, trying to get out a cogent message on economics. Bruce, link in global inflation with the recovery that we're seeing. Dovetail those two in. Is it a good inflation or a bad inflation?
I think there's some of both here. On the spike that we're seeing, there's definitely some problems in terms of companies adjusting supply to demand. That's the bottlenecks you see in the semiconductor. That's the used car prices. There's a bunch of those forces that are pushing up inflation, which is not great in terms of what we would like to see. The other side of this, though, is that we are seeing price normalization in what are depressed levels of service prices as we're seeing activity picking up. And I think that's obviously constructive. The bottom line, though, is we're getting a big spike in inflation here, and we're looking for another big number this week with a 5/10 rise in the U.S. core CPI.
What happens? What does the Fed do if we see that increase in CPI this week, if we see those inflationary pressures, but we don't see material improvement in the pace of job gains akin to what we saw on Friday?
So I think there's three things the Fed has to really work on. One is, I think, continuing to guide us that it's not going to change rates anytime soon in response to an inflation spike that they think is largely temporary. We think they're going to continue to guide that rates are going to at least be on hold through the end of 22. The second thing I think they need to do is start telling us that if they're wrong, and certainly they could be wrong, and inflation is more persistent, that down the road they can do what they need to do to keep inflation under control. And I think in that regard, they will, if not encourage, at least tolerate a rising expectation of rates over 23, 24. And then finally, what we're not going to get in June, but we need is more clarity about the balance sheet. I think they're going to tell us they're talking about it, but they're also going to tell us it's too soon to really lay out the parameters of what they do in terms of tapering and balance sheet movements more generally.
Bruce, our Bloomberg opinion columnist Marcus Ashworth today says it's really difficult to model the U.S. economy because the ferocity has been driven by monster fiscal injections and because the Fed has been deliberately vague about what inflation, what flexible targeting really means. How much harder is that making your job?
Well, I think forecasting is always difficult, particularly the future. Obviously, we're going through a very volatile period, but I think if you take the broad contours that the economy is entering a boom phase led by the consumer, that Europe is joining it, and as you just mentioned, the news on vaccines and viruses starting to look good globally. The simple issue is we're in a very strong phase of growth that's not going to go away anytime soon. The spike in inflation, I think, is largely temporary, but whatever is going to happen here, the Fed for the time being is going to be relatively cautious and continue to hold the line. And I think on the inflation targeting side, the Fed wants inflation to get up to the mid-2s for a while. It doesn't want it to get above 3, and it wants it to settle at 2 in the medium term. I don't think these parameters are that far, far away from where we might think ranges are, so that there's a lot of uncertainty. Executing is obviously very difficult, but I think the Fed's pretty clear on what it wants here.
Bruce, Michael Feroli and your team have led the way on our potential GDP, just the sort of where are we from a demographic and economic standpoint. Have you tweaked your potential GDP to be a more optimistic statistic coming out of this pandemic with all the stimulus?
It's an interesting question, and we're struggling with that. And we have not changed our view that U.S. potential growth is around 1.5. And as you can see in the latest employment report, and you can see more generally, there's been damage done to the supply side on labor. But at the same time, we've had a big productivity surge. Some of that is the rotation and growth to higher productivity sectors. It still remains to be seen what happens here in terms of lasting damage from this effect. And we're not at this point taking a view of really trying to change that view of a 1.5% potential growth rate.
Dr. Kasman, thank you so much. Bruce Kasman, JP Morgan chief economist, head of all of their global economic research. Lisa, a really good conversation there on a potential GDP, which is frankly Europe, like most Americans, I'm sorry, are simply not adjusted to a sub 2% potential GDP.
No, and this is a real question of whether we can get that sort of warp speed that can get us out of the hole that we are in. If we don't, I really raise this question about the inflation. You asked a really good question, Tom. Is it good inflation or is it bad inflation? I was out in California this weekend, don't ask, and you saw the price of gas at $4.50. What does that do to consumer appetite?
Well, where gas is where it's gas. Matt, how does Europe do high gas prices?
I mean, I was going to say, I would pay $4.50 to be able to pay $4.50 a gallon for gas. I mean, that is still pretty cheap compared to what I'm tanking with. And I use, I'm getting 10 miles a gallon with my truck here. So we just have other ways.
Are you the only one in Germany with an H2? I mean, are you the only one driving big Hummer?
He has his own oil rig.
I'm an H1 man.
Oh, H1.
I'm an H1 man. I need the 6.7 liter
Looks like you're
Duramax.
from one of the U.S. military bases. Matt Miller with us and Lisa Abramowitz. Bloomberg Surveillance. Matthias Cormann next.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plan, even if it triggers inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses. Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. In China, the trade boom continued last month. Exports grew almost 28% in dollar terms from a year earlier. That's weaker than forecast and below the pace in April, but it's still well above historical growth rates. Meanwhile, imports soared 51%, boosted by rising commodity prices. And in Germany, Armin Laschet has boosted his chances of succeeding Angela Merkel as Chancellor. In the final electoral contest before September's national election, Laschet guided the Christian Democrats to victory in the country's poorest state, Saxony-Anhalt. The outcome will help ease doubts about his suitability to lead Germany's conservatives. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
The Secretary of Treasury of the United States in London, Saleha Motion leading all of our coverage there this weekend. And if it was under your radar, particularly on the East Coast in 90-degree weather, really, really something as well. Before we continue this story, I do want to bring to your attention right now William Dudley with a scathing essay on Bloomberg Opinion released moments ago. I loved his last effort, which was much more supply, demand, and sequential dynamics. This is just, Mr. Powell, perhaps you have it wrong. The problem is that the Fed has put the new strategy into practice in an unnecessarily extreme way. Cooling things off will require the Fed to increase interest rates much faster and further than it would if it started raising rates sooner. We'll talk about that through the morning as well. Matthew Miller in for John Farrell, Lisa Brownson, Tom Keenan with us, Martin Schenker, who's in charge of G7 treaty analysis. Marty, that's the heart of the matter. This is a treaty.
It is a treaty, and the thing about treaties is that they have to be approved back home by the legislatures. And as our stories point out, this could take a very long time.
But what are the implications, Marty, when it comes to U.S. tax policy, since there are some, in order to get some of the policy up to speed with what the global agreement has?
Well, I mean, what it's really going to mean is that, you know, in order to implement a 15% minimum tax, you're going to have to change legislation in the U.S. You're going to have to apply that minimum tax to companies. And as we can see, Joe Biden's having a hell of a time getting Republicans to get on the same page on taxes.
This is something that we were talking about last week, Marty, because the Biden administration floated the possibility of a 15% minimum corporate tax instead of seeking a 28% rate. And to me, the fascinating thing was that would be a floor, meaning no matter how many deductions you have, no matter how many loopholes you've cajoled Congress to give you, you still have to pay 15%, which for so many companies would be worse than having just a 28% rate.
Yeah, and I think you're talking about people, companies like Amazon there. And it's true. It would, for some of us, remember the alternative minimum tax that used to be in play, and that's the same thing for companies that was for individuals. You would have to pay a certain minimum amount, and that would be a sea change.
We'll talk to Emily Wilkins later here, Marty, on what's going on in Washington. But I really want to underscore, as John Stolfus does at OPCO this morning, the motion interview with Janet Yellen in London as well. What did we learn from Saleha's interview with Secretary Yellen?
Well, she is, you know, and rightfully so, is making the case that, you know, if interest rates would have to rise as a result.
She said interest rates rising is a good thing.
Is a good thing. And there are a lot of people who agree with that. I'm sure the banking CEOs agree with that.
Well, it's a financial plus thing, but these are, I thought it was pretty bold statements by, I mean, maybe it's an economist rationalizing with their esteem as a central banker's treasury, but that was quite a weekend for a Secretary of Treasury.
Yeah, and, you know, she sort of ventured into the area of monetary policy as a Treasury Secretary, which is sort of not something you're supposed to do.
I'll say.
But, you know, she's very comfortable in her skin.
She's as rude as Abramowitz, and that's rude.
Tell me about it. Well, look, Janet Yellen, what was she saying? If we ended up with slightly higher interest rates, it would be actually a plus from society's point of view and the Fed's point of view. We've been fighting inflation that's too low and interest rates that are too low now for a decade. And that is a quote to Bloomberg Saleha Motion. There is a question here how much, Marty, this actually goes against Jay Powell versus really underscore the main takeaway here, which is that they do eventually want to normalize policy. However, there's a larger question, which is, do we really even want this? How is this being viewed in Washington that the Treasury Secretary is really acting increasingly like her former role as Fed chair?
Well, I don't think Washington as a whole really delves into the details like they do on surveillance, you know. But I do think it's interesting that Bill Dudley, as Tom pointed out on Bloomberg Opinion, is saying, yeah, interest rates are going to have to rise, but they're going to have to rise a lot bigger, more, and a lot faster than the Fed realizes. And you have him and Larry Summers, these traditional, more, you know, former policymakers sort of lining up in opposition to current economic policy.
Yeah, Dudley says that when they start to raise rates, if they push unemployment up by just 0.5%, that's very likely to cause a full-blown recession again. I wonder about the inflation side of things. Yellen says a little bit of inflation is a good thing too, and that seems to be consensus, Marty. But when I was a kid, you know, my grandparents lived on a fixed income. My parents, as far as I know, live on a fixed income. And that's not helpful to them, inflation. Doesn't that hurt savers? Doesn't that hurt retirees?
Well, it depends where the inflation is. If interest rates rise, I mean, money market funds are returning close to zero. So retirees who have fixed income, but their investments, their 401ks are going nowhere. So it depends where that inflation shows up.
I got to ask you. I mean, I'm going to get nothing out of London today, so you don't know who can help me. Lilibet Diana. I mean, they hit the ball out of the park in the name of the new baby, right?
Yeah, I think
they could not have gone wrong.
It was trending on Twitter, so it must have been a really good choice.
A large success, to say the least. Schenker didn't expect that question this morning. Martin Schenker, in charge of our royal coverage, or less royal coverage as well.
No. Hold on a second, Tom. Is that really the barometer of success, trending on Twitter? Did Marty Schenker just weigh in on that?
I once trended on Twitter for like 3 seconds.
Oh, yeah, for what? BitDog?
Yeah, I don't know what it was about, actually. I can't remember. I was like, oh, really? But there it is. Twitter's a mess. I mean, they're trying to make changes, Lisa, and it really folds into technology. Matt Miller, are you using Twitter a lot?
You know what? I'm on Twitter, and I wish I had the courage to commit Twitter side, because it really just takes up my time. It's a real time suck.
Yeah,
I don't like
it's a really interesting conundrum right now. They're trying to do some innovation there. That leads into the technology debate, certainly behind so much of what we see on taxation. Will be one of our themes again through the week and all this. Lisa, when's this conference? Do I really have to lose a surveillance nap to watch the Apple conference?
It's at 1 p.m.
today?
That is going to be the keynote.
It's in the heart. Come on.
I mean, I don't think that you're going to lose the surveillance nap for this. I think it's interesting in light of the fact that there has been a revolt among Apple workers after being told that they had to come back to the office 3 times a week. Did you read about this?
Yeah.
And they basically said, no, you don't understand us, and they protested it. Tim Cook, you aren't listening to our feedback, raising a question of whether it's legitimate for employees to push back against their employers, for employers to demand coming back to the office.
We're going to have a really definitive interview on this in the 8 o'clock hour with an academic from Stanford who is truly expert on the actual research of really the research of work from home. We're really looking forward to that as well. The resilience of the equity market defies Lisa Abramowitz. It is a bull market right now with red and green on the screen. The Dow futures up 6. I'm just quoting that for Farrow. Dow futures 6. Let's do a Dow level for John. 34,749 on the Dow level right now. The VIX 17.12. Coming up, Urian Timmer of Fidelity, an important interview. Stay with us. This is Bloomberg on radio and television.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg Surveillance on radio and television. Good morning, everyone. Tom Keene, John Farrow, and Lisa Bramwitz. Mr. Farrow off, Matt Miller in Berlin with us. Romaine Bostic scheduled, I believe, if he gets here in time. So the Sikorsky has trouble in the 90-degree weather. We'll see if we can get Romaine here for the next hour as well. Right now, a really important interview, and particularly for those of you that enjoy the heritage of Wall Street. Urian Timmer is with Fidelity Investments. He's got a fancy title called Global Macro Director, but the real Urian Timmer is the keeper of the charts. At 82 Devonshire in Boston is the most important paper display of charts in the business. It truly is the Vatican of technical analysis in the world, and we're thrilled that Mr. Timmer could join us this morning. Urian, which chart matters the most right now?
Well, many of them matters, but I would say the one that I follow, if I only had one indicator, it would be the chart of real rates, especially the 5-year real yield, so the 5-year TIPS real yield. And that one is near -2%. And I think that level and magnitude of negative real rates is really what has driven a lot of this market. So obviously, that is highly reflationary, a period of negative real rates. We saw that during World War II when we had financial, et cetera. So real rates, especially the 5-year, because that one is most impacted by the Fed, right? Because the Fed is buying in the belly of the curve. It sets forward guidance out that long. So the 5-year rather than the 10-year, that to me is the chart right now.
Urian Timmer on the same page as Lisa Bramwitz. Lisa, you really highlighted the distinction here of the 10-year and the 5-year inflation-adjusted yield.
Yeah, the question that I have, Urian, is that this market has been rather boring, right? I mean, it looks like people think that the Fed has it right. They're kind of waiting for something to change. You think that things aren't quite as boring. Can you explain?
Yes, so yeah, we look at the 10-year, right? It's 155, 160. The high was 175. That last run up to 175 started to be driven more by real rates going less negative rather than inflation expectations going up. And that is a huge distinction, right? I mean, I think the Fed, as well as the markets, don't really mind rising rates as long as they're rising for the right reason, which would be inflation. But if they're rising for the wrong reason, which would be real rates going up or becoming less negative, different story. Then you get into taper tantrum territory, triple T's there. But for the stock market, market hasn't done anything. It's gone literally sideways, but beneath the surface, you can see rotation, right? So earlier in the year, we had the meme stocks. I mean, they're kind of back now, but with the meme stocks, we had the kind of the IPOs, the non-profitable tech baskets. We had, the secular growers, all very sensitive to the liquidity environment. The secular growers, of course, very impacted by rises in the discount rate per the discounted cash flow model. And so one by one, these kind of high-flying momentum sectors kind of were taken out to the woodshed, and the crypto stuff is kind of in the crosshairs right now. And so even though the S&P just sits there at 41, 4,200, lots of churn underneath. And, you could say even that that's a correction. And, I bring it back to kind of the financial crisis, 2009, 2010, we had that enormous rally off the March 09 low, 75% gain. Then QE1 ended in April of 2010. Market then fell kind of a very uniformly, 15, 16% before it resumed the bull market. We're kind of in the same transition where we had a valuation-driven phase of the rally, the early cycle phase. Now we're moving towards an earnings-driven phase of the rally. So the rate of change of the PE is peaked. The rate of change of trailing earnings is flipping from negative to positive. But in that transition, sometimes you get a little indigestion, and because usually the Fed is in there trying to normalize policy. And of course, that's the big discussion we're having. So whether we see a correction here, a short-term correction, or whether it's all underneath the surface is something that we don't really know. But there is stuff going on for sure.
Wait, Jurrien, can you elaborate a little bit? There's a lot there to unpack. This idea that potentially the market is due for a broader drawdown, and it could be triggered by a Fed policy error, or even just the suggestion of tapering. Is that what you foresee in the next few months?
Yeah, and I wouldn't even call it an error. I mean, it's hard for the Fed to maintain the degree of accommodation when the output gap, which of course opened up very, very widely during the pandemic, is closing fairly rapidly. Now, we've had 2 payroll misses in a row, and maybe that pushes the taper conversation from their June FOMC, which of course is right around the corner. Maybe it pushes it to Jackson Hole in August. But, it's inevitable that conversation has to happen. And even when you hear things from the Treasury Secretary, they're almost kind of hints that, to kind of give the Fed cover that, it's okay to normalize policy because conditions are better. But, there is still a gap, right? The U3 unemployment rate is still about 1.6% percentage points above.
Okay, traders, all of you who decided to trade euro against United States dollar, as you can see, it moved down, and it's time right now to place stop on profit. So we will place stop on profit 2 pips below the price. It means because we sold short, it will be our profit. For you guys, it's all about how much you decided to invest. So for us, 2 pips equals 200 pounds. 1 pip equals 100 pounds. I hope you read the description. If you have a strategy, you know exactly what we're doing, and you know exactly what to do. Okay, so please place stop on profit, and let's see what's going to happen with euro. If it will go further down, we will increase our profit. If it will move up, you will feel this order, and you will still end up in profit. So you will not lose any money at all. Okay, guys? Stay safe, and I'll speak to you later. Let's see where this pair will lead us.
And then
okay? I'll speak to you later, guys.
The rally comes because the Fed is pumping money into the system. You get that valuation-driven rally where the worst stocks are going up the fastest because they've gone down the most. So companies with bad balance sheets, for instance. And then the delta, the rate of change of the PE starts to peak, and the delta of the rate, or the rate of change of the EP bottoms, and then the 2 flip over. And we're at the point where they are now flipping over. Same thing happened April 2010 when QE1 ran out. And if you remember, of course, it ended up with the Fed having to QE2, which I'm sure it wasn't planning to do back in April of 2010. So we don't know what will happen here. If a full-on taper, if it pushes the 10-year north of 2%, which is that's not a prediction, but let's say if it did, and the Fed then decided that we can't afford rates above 2 or 2.5, maybe we then get another bout of QE to try to keep rates low. But that's kind of one of the future in the chess game, not right now.
How much does inflation matter, Jurrien? I stumbled across a chart this morning which really shocked me, and it's basically just core PCE. The jump that we've seen over the last few months is pretty impressive. I didn't put this chart in log yet. I'm asking our New York City chart producer, Dan Curtis, to do that for Tom. But we haven't seen this kind of jump in core PCE in the last, since I did my GED in 1991. Roger Boodle, who wrote about the death of inflation back then, says we could be at the beginning of a sea change now. What are your views on inflation?
Well, that is the big conversation that we're all having here among my colleagues at Fidelity, and of course everyone else is as well. We know we have transitory inflation, and by definition, it is transitory just from a rate of change base effect, aspect, because you always have to look at the level and the flow, right? So we know the flow is going up because we have the base effect from a year ago. We have the reopening dynamics, we have bottlenecks, it's low inventories, etc. So the increase in the CPI or the PCE was a mathematical kind of certainty almost, and that rate of change will peak at some point in the next few months, and then it will come down. But then the question is, what does it come down to, right? If it went from 1 to 5 and then it goes to 2 and then it goes back up to 4, at that point you start to get structural inflation because the level kind of settles in at a higher point. I can relate to this as a chartist. So you start to seeing those higher highs and higher lows. That's what we saw in the mid-60s into the early 70s. And again, I don't want to draw that parallel because the 70s were not a pleasant period. But for the markets, again, if rates are rising because inflation is rising, I think the markets, both the bond markets, the stock market, the Fed will be okay. And sectors that work, right? Energy, financials, materials, industrials, all are very positively correlated to changes in the 5-year yield. And then the consumer staples, the bond proxies, tech is very negatively correlated. So there's going to be winners and losers, and that's what the market is already figuring out right now. But ultimately, from my perspective, the big question is if inflation does become entrenched, that's going to undermine the 60-40 paradigm, because at that point, the 40 is no longer going to be negatively correlated to the 60, and then you need to start tinkering with the portfolio to make sure you have the right things in that 40, and that very, very well may include gold and even digital gold.
Urian, thank you so much. Urian Timmer with Fidelity. We have to get you back again soon. Head of Global Macro Direction at Fidelity as well. Lisa, I look at where we are and with the Fidelity mantra, and I really wonder about equity forward. Do you go over diversified? Do you go more focused diversified like a Peter Lynch model of years ago, or even the Fidelity 50 fund? I mean, there's a huge debate about this.
Well, and a lot of people have been calling for the death of the 60-40 portfolio for a long time, and yet it has performed pretty well consistently, with bond yields continuing to plunge into new low territories. I do wonder, Tom, when people say that we're entering a new inflationary regime, what has changed demographically from a debt load perspective, from an innovation perspective, that could lead to that kind of inflation? And right now, the market isn't buying that story, but there are more people on the
monetary theory
coming out.
MMT.
Well, okay. Perhaps, but we're not necessarily seeing that with respect to the velocity of money. We're not yet seeing that with respect to wages flying. Not saying we're not going to, but Tom, this to me is one of the questions.
Well, we're going to have to see. To me, it's absolutely fascinating, and so much of this is about what you do with your portfolio forward, given all the easy money that's been made for a select few. Chair Yellen still active as Secretary Yellen, her splash over the weekend, and a new headline out from Secretary Yellen here at a summit, Select USA Summit. U.S. economy transitioning to a pre-pandemic state. That's the same for Matt Miller. He's transitioning to a pre-pandemic state. Stay with us.
With the First Word News, I'm Mariska Gupta. Bank of America President Brian Moynihan says consumer spending has surged amid the reopening, and he says much of that is due to leftover stimulus money. Moynihan told CBS News that spending by B of A customers is up 20% from 2019. In Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress, but a survey indicates his coalition won't retain a supermajority needed to pass constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiko Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of jailed former President Alberto Fujimori. Bloomberg's learned that KKR is close to reaching an agreement to buy Atlantic Aviation from Macquarie Infrastructure. The deal could value the airport services company at about $4.5 billion, including debt. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. And shares of Tesla are lower. The electric car maker called off plans to build a Model S Plaid Plus. That's the longer-range version of its high-end sedan. Tesla CEO Elon Musk tweeted that the Plaid Plus will be cancelled because the Plaid version is, quote, just so good. And it would be one of the biggest leveraged buyouts of all time. A consortium of private equity firms reached an agreement to buy medical supply company Medline Industries.
Okay, guys, well done. Position closed at euro at 121.55.6. We made £200. Let's move on. Let's see what other Forex pairs will give us, what kind of profit we'll get from other Forex pairs. In the meantime, I will show for newcomers how we made a profit. And let's move on. Let's move on. Let's not concentrate only on one winning. It's just middle of the day in the United Kingdom, so we still have time. Stay safe, guys, and I'll speak to you later. Okay, guys?
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
That happens via social network mechanisms that really allows for things that are inflammatory, things that seem more challenging, things seem more dangerous, but are yet not fact-based, to really spread like wildfire.
And at Pecos on Friday with a briefing there on the pandemic. We continue that story forward. We welcome all of you. John Farrow's off, Matthew Miller in Berlin in the summer with Lisa Bramwitz and Tom Keene. We've got futures red and green on the screen. SPX -5, Dow +25. The VIX, I'm going to call it stasis, 17.06. The headline statistic for me to 4 digits, 1.5789. On the 10-year yield. That's extraordinary for any measurement. As Lisa mentioned earlier, 162 is where we were, and now we're 5 basis points in as well. Brent crude 71.48. Joining us now, Joshua Sharfstein with Johns Hopkins, the Bloomberg School of Public Health, and their vice dean. Over the weekend, Joshua, I was shocked at the medical statistics for the hospitalization of teens with COVID. The idea that 30% are in intensive care, that 5% are on a ventilator is, well, describe for us COVID in kids. What's it really look like?
Well, it can look like COVID in adults. It can be quite serious. It's less likely to look like COVID in adults, but adolescents can absolutely get sick, and when they do, it can be quite serious. You know, what we're seeing is that the variants that have emerged appear to be more likely to get kids sick and potentially get them sicker. And so, you know, the idea that, well, this is just a common cold in adolescents isn't necessarily true. And also, if you think about just in general how risk averse we are for kids, we don't want our kids to face even a small risk of a catastrophic outcome. It really does make sense to vaccinate, given where we are right now.
Does the vaccination trends for kids look pretty much the same as adults? Is there a nuance there that you've gleaned at Johns Hopkins?
I think it's a little early to say too much about where we are, but I think there probably will be regional differences. You know, I think that it's important to build parents' confidence first. Have a lot of kids vaccinated and have them tell their friends, and just generally get you know, word of mouth going and other things in order to get people confident about vaccinating their kids. But you know, it's also important for the federal government to be updating people on the safety of the vaccines for kids, just like they were doing for adults and pregnant women and others.
What's the threshold, Dr. Sharfstein, for moving into a post-pandemic reality where we treat COVID like the flu?
You know, I think we're still a little bit a ways from that. You know, I'd like to see there to be so much vaccination that really the number of cases and the risk is hopefully, you know, about an average flu season or less. I mean, that would be, then you could kind of treat it like the flu, but we're not at all near that point. The projections are that if we don't vaccinate more people, we will have many more people sick and a lot of people dying, far in excess of the flu. And so, you know, we're just going to have to keep treating this like it is until we get to that point.
What do you say, Dr. Sharfstein, then to people who are sick of this, who want to move on with their lives, want to see people, want to travel? You're seeing people refusing to wear masks in increasing locations, saying that you can see that the virus counts are trending lower. What's the risk of losing credibility with the public by hammering home the ongoing social distancing and measures that you say are prudent in order to get the virus levels down to a level where we can move beyond?
Well, I think that the social distancing and those sorts of measures should reflect the state of the epidemic, the pandemic in a particular region. So if there are no cases, there's not a need to, you know, have a mask mandate, for example. But I think at the same time, the concept that it could come back shouldn't be some sort of, you know, crazy thing to say, because it could come back. And the way we keep it from coming back when weather gets cold, when people come together, is through vaccination. And so I think the focus as the cases come down should shift to, you know, continuing to make the case for vaccination. And, you know, in the end, that's just the way it is. You know, we can't psychologize our way out of the virus. The virus is waiting for us. And we really need to emphasize what we can do together to keep there from being a false surge.
Well, it could come back stronger and more dangerous, right, Dr. Sharfstein? This is my concern with the, you know, the anti-vaxxers or those who don't want to get vaccinated for whatever reason. could pose a danger still to the majority of people who do get vaccinated, in that they could carry this virus and allow it to mutate into something that ends up overcoming the efficacy of the Pfizer and BioNTech vaccines.
I mean, in theory, that's possible, but I just think it's terrible if they themselves and others who've been misled and haven't gotten vaccinated get sick, and that's basically a sure bet to happen if we have a major surge again. So, you know, one of the things is from the very beginning of the pandemic, every time cases went down, there were people out there declaring victory. Now cases are going way down, so it's extra tempting to declare victory. But we're not in that spot yet, and we have to find ways to communicate, you know, both that, yes, we're in a better spot, we can do more now, but if we want to continue to be improving and not risk a big problem in the fall, you know, we have to continue to encourage vaccination and get the numbers up, you know, to a level where we shut the door on the virus really causing a big problem in the fall.
Dr. Sharfstein, thank you so much. Greatly appreciate it. With Johns Hopkins, the Bloomberg School of Public Health, of course, Mr. Bloomberg, principal owner of this television and radio operation as well. It is an extraordinary headline. It is a headline of courage. It is a headline, frankly, of surprise. Jeffrey Bezos, with his brother, will travel into space. They will be going on New Shepard, named after the great Alan Shepard, and they're looking for someone to go with them. And there's a whole thing out at the Blue Origin website where you can pony up a fee. We want to announce that the Matthew Miller Patreon Fund to put Matt Miller into space. We'd like to say keep him there. is with us. Matt, I think, you know, I know you're into cars and all that, but this is really something that this guy's going to actually just shut up and do it and go up there.
To me, it's unbelievable because he's worth $186.8 billion. You know, I mean, he alone, not even including the fortune of his ex-wife, is the richest man in the entire world, over Musk, over Gates, over Buffett, and he's going to risk that fortune.
New Shepard, the flight experience, Mach 3 Plus. They go up to apogee, which is above the so-called Kármán line.
Matt, you're going to let this go? Tom just tried to send you to space and keep you there. You know,
I'm willing. I'm ready and willing.
They're up to like 2.8 million, I think.
Question, though, about the idea of recreational space travel. How close are we to that moment?
We're going to find out. Really something, really remarkable. And of course, we'll have our continuing space coverage led by Riley from St. Louis. We're really looking forward to that here in the coming weeks. Maybe Mr. Musk will top him and go into space with a Tesla. This is Bloomberg. Good morning. Stay with us.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year.
Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's hard to have much of an inflation problem if wages are still quite quiescent.
We're recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The market's a little too complacent about the Fed not even talking about tapering.
We are still awash with excess liquidity, and that helps to support a lot of valuations.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on television, on radio, a simulcast on a Monday. Really, really easy conceptual ideas out there. G7 treaty, this, voting rights, that. A little bit about the market. But in the market, Lisa Abramowitz, I got to say, I got a 157 yield. That is different from 5 days ago.
Yeah, the idea here is that the balance of movement might even be lower, that the Fed is right, that inflation is transitory, and that perhaps the jobs market isn't picking up as quickly as people had previously expected. And we did see a bit of a gain in terms of the yield, price down, yield a little bit higher today after Friday's move, but nothing to write home for. You know, the idea here is we're in a low yield regime for the longer term.
John
for
Farrow,
today.
John Farrow off today, folks. Romaine Bostic in to assist Ford. Romaine, I got to get up to speed on the memishness of this Monday morning. I've actually heard absolutely zero about it. Is that so done?
Well, I mean, at least for now. I mean, it looks a little bit less memish this morning. I think some of the bloom has come off of that rose, and I think a lot of people are focused in on some of the more tangible factors that have been driving this market, things that have a lot less to do.
We have to stop the show. I mean, on radio, this is spectacular. Romaine and I went back and forth on Friday, and we decided orange was the color of our bow ties for today. And Lisa, you know, she was...
I just failed.
She was like tasting wine or something this weekend and missed
I may have been.
The orange bow tie. On radio, we welcome all of you as we are ensconced in orange bow ties. This morning, seriously, Romaine, I mean, GameStop, Joe Feldman walks away from it at Telsey Advisory Group. Is anybody walking away from AMC?
Well, I mean, pretty much all the analysts were relatively bearish on this. Keep in mind that in the last week, the highest price target on this thing was like $6.50, and you had a couple of folks down at $1 here. So the fundamental bearishness, I think, that existed, at least amongst the sell-side analysts, that's still there. As far as the euphoria amongst the retail traders, I think you're seeing the volumes come down a little bit this morning, at least relative to what we saw over the past couple of weeks. Whether that actually is going to be enough to drag this stock even further down, who knows? It's still up slightly here in pre-market by about 3%.
But now there's a moment of reckoning, Tom, and that is that the Russell is going to potentially come out and shift AMC, shift GameStop into the Russell 1000, which makes them less of a weighting. This matters because basically basically, these meme stocks have become a significant proportion of indexes that people track with their 401ks.
Yeah.
And you do wonder what the implication is going forward.
We're going to go to Emily Wilkins on all that's going on in Washington. Really got quite a news flow for June in Washington. Right now, let's look at the data. Red and green on the screen here. The resiliency of the equity markets has been noted near record highs off of Friday, and with the VIX with a 16 level, 16.96 on the VIX. Again, Romaine, I'm going to let you do the yield space. 1.58% on the 10 years, a wow statistic.
Yeah, and this was actually an interesting move we saw on Friday, because we keep talking about how the fixed income market, the treasury market, at least really wasn't reacting much to a lot of the data and a lot of the Fed speak. We finally got that reaction on Friday with that 7 basis point drop on the 10-year yield. You're seeing the further decline in those yields today here. I think that gives you a sense here that now the market has found a little bit more clarity about what they think the Fed might start thinking about doing, and now you're going to start to see a little bit of movement here to the downside.
We got a lot of M&A going on as well. We're going to blow past that here at the top of the hour, but we had a huge LBO in the healthcare business over the weekend, and just in the last 10 minutes is presumed KKR involved in a transaction, and Blackstone involved as well, the sum of which is nicely over $10 billion. We'll get more on that here in a bit. We need to get briefed because we picked the orange apple, the orange iMac.
The orange iMac, perhaps the orange iPad Pro, which has wireless charging and will be in the Keene household in a brown box within perhaps the next 12 months. Apple is going to be hosting its annual Worldwide Developers Conference, second year that it's actually virtual. We're looking at the share price right now, down 0.2%. Amazing that it's not down more considering the tax implications over the weekend with G7. But really, it is all about cash flow, the massive cash flow that the likes of the Keene household funnels into this company. Then today, President Biden is going to be speaking with the key architect, the leader of the Republican effort. That would be Senator Shelley Moore Capito. She's going to be talking with him yet again. No deadline. This is a good thing. The infrastructure bill looking more likely given the fact that there still are talks ongoing, and there haven't been firm ultimatums in firm terms of deadlines or in terms of numbers on either side. And this I really love, that young teens, 12 to 15-year-olds in Germany, can start getting COVID vaccinations for the first time starting today, really highlighting where we are in the COVID pandemic cycle. We are entering a new phase with the lowest rate of infection in 3 months globally, the lowest rate of infection in the U.S. going back to March 2020. Are we there yet, Tom? And that is what we hopefully can say the answer is maybe. Close?
You know, as Mr. Bremer would say, Dr. Bremer would say, every nation for itself. And certainly we've got a nice set of stories out there, some very good news stories, maybe the cacophony that we see in the United Kingdom, and some difficult stories out there still on lockdown as well. We begin strong in this hour. Troy Gajewski joins us with Skybridge here on the making of alpha, beta, gamma, and the rest of it within the hedge fund business. Troy, I see all sorts of articles that it's been a really whipsawed challenge 6 weeks or so for the hedge fund business. How is it? Is there alpha out there?
Yeah, but you're right. It has been challenging, particularly in long-short equity, really starting since February. And what we saw is that, remember, and this gets back to some of the inflation concerns and where the Treasury yield is now, is that, the industry was really positioned for, slower growth, potentially, less fiscal stimulus coming. And so they were overweight growth in stay-at-home names to some extent. Those have underperformed recently, and a lot of the value cyclicals have really screamed. And so it's been a choppy environment in long-short equity. Last year was a very strong alpha year. This year's been a slight negative alpha year. So it's been harder in the equity part of the capital structure. That being said, if you look at distressed debt managers or those in structured credit, they're principally recovery/value plays. So those have performed very admirably through June 7th so far this year.
We could talk all about that, Troy, but really everyone wants to know about Bitcoin and your holding in the crypto asset, considering the fact that you have made such a big push saying that this is going to be the key determining factor in your outperformance this year. Where do you stand on that now, given China's noise around potential crackdowns, regulatory issues, and the fact that we're perhaps moving into a new regime of liquidity?
Yeah, so look, we step back and still look at the initial thesis, right? You still have tremendous money supply growth. The Fed is still expanding their balance sheet by $120 billion a month. M2's on pace to grow somewhere between 15 and 17% this year. You think of every central bank and every nation state is still in a debasement period for their currencies. So the macro environment is still very favorable. And as you were talking about before, it doesn't look like there's any urgency for the Fed to taper. They may announce a taper at the end of this year and start to taper sometime early 2022, but that's the most likely path. And then from an adoption standpoint, again, we still think we're very early. You look at some of the high net worth or the wealth management platform products. Morgan Stanley's has raised $150 million already. You look at gradual adoption in the hedge fund industry and the asset management industry, that continues. And then lastly, we're still relatively early post-halving. The last halving was May 11th of last year. Typically, you have an 18 to 24-month bull market. So we still think we're in a bull market. Obviously, we had a very horrific correction, but we think the trend line is still up here over the next 3 to 6 months.
And you think there's a floor built into that, Troy? I mean, because a lot of people look at the current prices, they wonder about some of the institutional embrace of this and whether that's going to be enough of a floor to keep things from going lower.
Well, yeah, so obviously after the big dislocation we had, we built up a nice stability zone here in this 33 to 36,000 level. It will be hard to push meaningfully above 40 to 45 in the near term. But again, if you go back and look at previous bull markets, you had substantial corrections along the way. This one was obviously more profound. You do highlight a good point on the environmental concerns, is that may slow down some institutional adoption. But again, if you step back and look at your choices for how you play currency debasement, if you care about liquidity and you care about non-correlation, Bitcoin in particular is still a very strong choice for you, alongside gold and maybe to a lesser extent copper. But copper, of course, it's a very cyclical recovery play that's already rallied. It's up 100% over a very short period of time.
Troy, I want to talk about the big tech, big cap. We've got the Apple conference today, something that we'll be covering, of course, across all of the afternoon. Troy, there's a comfort factor for hedge funds to own those companies. Describe the intellectual process of hedge funds loading the boat on large cap profit-making tech.
Yeah, loading the boat's a strong term, Tom, because I think there is some distinction in which names they own. But the industry particularly is as long Facebook and Google as we've ever seen them. When you have great value investors like Seth Klarman with, 2 of the top 10 names are Facebook and Google, for instance, that says a lot. And, so the intellectual process is pretty straightforward. It's like, hey, we're going to be mean reverting here to a slower growth environment again after a big cyclical growth period. You have tremendous profit margins, tremendous cash flow generation. There's really no cost pressures in terms of, expenses, meaning it's not a labor intensive industry that's going to suffer from higher wages, for instance. And, on a valuation standpoint, they haven't been cheaper relative to the broader markets pre-pandemic days. So, as hedge funds filter through their choices, if you're filtering for risk-adjusted returns, particularly in an environment that'll mean revert to slower growth, those look like standout winners to the hedge fund industry.
Troy, thank you so much. Troy Gayeski, a briefing there on the state of alternative investments with Skybridge as well. Romaine, I think this really folds into what you're going to deal with this afternoon. Apple's going to go out and chat it up as well, but there's a raging debate about cyclical value rotation versus, hey, you got to own some of the big tech.
Yeah, and a lot of that debate, though, is really about how you define what is value these days. And a lot of people look at Apple and they throw it into that category. That's become the safety valve for a lot of people in this market. They fall back on it, and then they fall out of favor with it, and then they look at that revenue growth, they look at that margin growth, and they come back.
Yeah, and Lisa, you and I are dealing with this. I mean, the reality is you get the terse little 2 paragraphs from the school, and they say, for the fall, Ignatius needs something Apple-like.
Yeah, someone needs an iPad,
whatever,
whatever, iMac. Honestly,
whatever.
Yes, which is the reason why all of these regulatory concerns, antitrust concerns, shrugged off. Really, doesn't matter what the headline is. It doesn't affect the shares.
You opened the show with that, and you are dead on. We're seeing that shrug off again. Stability in the equity markets. This is Bloomberg. Stay with us.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plan, even if it triggers inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses, and Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. Google will pay $268 million to settle an antitrust investigation in France, and it's agreed to change the way its business works across the world. France's antitrust agency said that Google used its dominance over ad sales and purchasing on its platforms to distort the market, hurting rivals such as Rupert Murdoch's News Corporation. And a couple of big deals in the news today. According to Dow Jones, Blackstone Group has agreed to buy data center operator QTS Realty Trust for roughly $6.7 billion, that representing a 21% premium to QTS's closing price on Friday. Meanwhile, Macquarie Infrastructure has agreed to sell Atlantic Aviation to KKR. The deal values the airport services company at almost $4.5 billion. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
There's no, hardwired deadline. We are doing the work of legislating. This is a big week, so we won't do this forever. But right now, there are good faith efforts on both sides, and we're going to continue the work of, doing our job and trying to get a bipartisan agreement.
The Secretary of Commerce, Gina Raimondo of Rhode Island there, managing through. Everybody's returned here on a June 7, and, well, we are going to have an active June, to say the least, in government. An active market this morning, red and green on the screen, but a stability to equities with Dow futures up 29, S&P futures -2. I really want to point out as well, Brent crude sustains near 72, rounded up on Brent crude. Dollar with a little bit of a rebound. Matt Miller mentioning the 6 o'clock hour, 121.59 on euro. Romaine Bostikin for John Farrell, Lisa Bramwitz, and Tom Keene. We welcome all of you on radio and on television. Emily Wilkins joins now from Washington. Emily, what is the spillover of the senator from West Virginia speaking with such clarity in an editorial in West Virginia on voting rights? How does the Manchin effect from that spill over into other domestic issues in Washington?
Well, I don't think it was a huge surprise for those of us who have been very closely watching Senator Joe Manchin to hear what he said in his op-ed over the weekend. I mean, I think to a certain extent, this really emphasizes exactly how much Manchin wants to see that bipartisanship, wants to see sort of the Senate be fixed in a way, sort of overcome some of these partisan tensions. And that's something that's got to be weighing on President Biden's mind this morning as he debates whether or not to continue negotiations with Senate Republicans over the infrastructure package, or whether to say, you know what, we need to cut ties, we need to go it alone, we've got a lot of work to get done. Because remember, even if they go it alone with just Democrats, that doesn't mean that an agreement comes together like that. It means that we got to spend more time getting Democrats on board, because you've got so many different moderates and progressives who want different things out of this bill.
It almost reminds me of Speaker Boehner years ago. You say he's got to get just Democrats on board. Isn't that impossible right now?
I don't know if they would say it's impossible. It's certainly something where we talk to Democrats. They say, look, we want to get something done. There is widespread consensus across the Democratic Party that they do want to get some sort of package done. What that looks like, what the tax increases are, all of that stuff is being debated, but there is a sense that everyone wants to get to yes on the Democratic side of things.
All right, but we heard from Chris Van Hollen basically saying, Emily, the time here is perishable, and there does seem to be a clock that's been ticking right now for Biden. The idea here that if this doesn't get done, or at least something, I guess a handshake agreement at least doesn't get done within the next few weeks here, this might not get done at all this year.
Right. I mean, Democrats are really worried about seeing a repeat of what happened back in 2009 with the Affordable Care Act on health care, when they negotiated with Republicans for months and months and months, and no Republican signed on to that bill. I mean, think about the timeline here, too. If they can get a bill to pass this year, it's going to take time for the money to get out there, to trickle down into communities, and in the infrastructure component for shovels to go into the ground and people to start seeing the benefits. Democrats want all that to occur before November of 2022, and that's something that they are taking into their calculations when they're putting pressure on the president to say, hey, we want to see something happen in a bipartisan manner, but the clock's ticking it, and we got to decide whether or not we need to move on our own.
We're speaking with Emily Wilkins of Bloomberg Government about the potential or the lack of potential for bipartisan agreement on infrastructure. There is, however, an emerging bipartisan agreement on something that may seem sort of fringe-like, but actually really caught my interest over the weekend. Senator Mark Warner of Virginia came out and said that companies should be mandated to report, to disclose whether they've had to pay some of the ransomware bribes, basically to pay out people in order to release information. This goes to the Colonial Pipeline disruption that we saw earlier, and it raises questions even about whether paying some of these ransoms should be made illegal. How much bipartisan support is there? I mean, this could potentially actually have a real effect on the market.
No, that's an absolutely great question. And I think it's one that Congress is really starting to grapple with in a bigger way now that we've seen some of these high-profile companies be hacked. The SolarWinds hack earlier this year certainly was at an enormous scale. And so you do have a sense, and I think it is on sort of both sides of the aisle, that there is some concern about what happens when companies pay this amount to hackers. I think this is a debate that's still really unfolding in Congress. I mean, the Senate was out all of last week, so now they're back this week. I would expect to see sort of more conversation conversations about what exactly needs to be done. Of course, Republicans, there's always some hesitancy about telling the private sector what to do, but I think there's also a sense that there's some big concerns about what it means for Americans when you see companies like Colonial Pipeline get hacked and gas prices shoot up.
Emily, which Democrat are you watching this week away from the big names? Who really matters in Washington this week?
That's a really great question, Tom. I'm going to stick to the Senate because the Senate is the one back in session. And I think, we talk a lot about Joe Manchin. I think Kirsten Sinema, her name gets thrown out there as well. But there are a number of other moderate Democrats to watch for these things. Angus King, Jean Shaheen, even Mark
Okay,
Kelly
well, let's
from
go to
Arizona.
Angus King. Let's go to the gentleman from Maine is well here. What is Angus King's power in negotiation with the President of the United States?
I mean, Angus King, as a moderate Democrat, he can sort of try and make some inroads between Senator Manchin and President Biden, because he's someone who Manchin can sort of look at and say, look, this guy's an independent. He caucuses with the Democrats, but he still has sort of that independent streak to him. And that can be someone who sort of helps shape Manchin's thinking on certain things. I mean, this isn't a vacuum here. Certainly the senators, they speak to each other, they talk with each other, and I'm sure there are plenty of discussions between more moderate senators of the party and sort of where they think they can go, what pressure they might be able to exert on the more progressive members of their party, as well as party leadership.
Emily Wilkins, thank you so much from Washington, a briefing there on a Monday. They've a very, very active week, much busier than I thought it would be here in early June in Washington. Lisa, to prepare for our interview with Matthias Cormann, really interesting with the OECD, a gentleman from Belgium, a gentleman with I'm going to call it Germanic education, and he lands up in Perth, Australia.
Yeah, there's a question of the international feature of the business world post-pandemic. Also, I am curious to know the idea of global inflation and global growth when you talked about something very important, Tom, which is the very country-specific nature of this pandemic. And I was reading a story over the weekend about how small businesses in developing markets have just gotten eviscerated by the pandemic. What does that do to growth, considering how many of the jobs they supply in the world?
I can say the same thing in the United States as well. I mean, Romaine, you look across the equity markets, and we really haven't had in the last number of weeks this debate about small cap, call it small business, mid cap, and the large cap companies. I mean, that's an open debate into the summer.
Yeah, it remains an open debate, and that's why you see this sort of rotation in and out of these stocks over the last really 8 weeks now. Yeah, I mean, and a lot of people really trying to figure it out, and a lot of that really does hinge, once again, on monetary policy, and to a certain extent, a significant extent, to what happens with fiscal policy and whether Biden is successful in some of these proposals.
I want to draw everybody's attention to William Dudley writing actively for Bloomberg Opinion. His piece a week ago I thought was just extraordinary on the sequence here that the Fed would look at. And today he just simply comes out, Bill Dudley, the former president of the New York Fed, and said this is a Fed that has moved out to extremes, to use his language. That'll be an important essay for all of economics today. Red and green on the screen. Dow futures up 36, 34,779. We say good morning to John from Coventry. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
On radio and television, Bloomberg Surveillance, John Farrow, Lisa Branwitz, and Tom Keene. Good morning to all of you. Jonathan Farrow is off. Romaine Bostic with us this morning. On the data front, the yield on the 10-year speaks volumes, 1.57, rounded up 1.58% after a stunning move on Friday off of jobs. A real yield, well, it churns here, negative 0.86% as well. And in the equity markets, we near record highs. We continue to sustain ever so slightly red and green on the screen, but the VIX a constructive 16.91. On the equity markets, Romaine Bostic.
Yeah, and remember, Tom, on Friday, we actually traded above that record high on the S&P 500, and a big part of the reason was because of sort of the reemergence of big tech. Keep an eye on big tech this morning and throughout the day. Of course, Apple has its Worldwide Developers Conference later today. We'll see whether that momentum with regards to this new product cycle and the embrace or the forced embrace of a lot of these products continues here. Apple up slightly here in the pre-market, up about by 0.2%. Also keep an eye on Biogen. This is going to be huge. JP Morgan calling this the mother of all binary events. Of course, the cognitive disease drug that it's been working on that could potentially be sort of a treatment for Alzheimer's. The FDA is set to make a decision on that sometime today, probably after the close of market. Those shares, though, nevertheless, have been rallying over the past few days, up 3% here in pre-market. Keep an eye on Eli Lilly, Cassava, and a few others that would stand to benefit should this get approval. Then keep an eye on Tesla. Unfortunately, more bad news here. If you were planning to get your hands on that new edition of the Model S, this was the Plaid Plus edition. Elon Musk basically saying that's not going to happen right now. Not really clear. The share's down slightly here on the day, but they've been camped out right below 600 for the last couple of weeks now. Flip up the board, a few other names to keep an eye on. We'll give you your AMC update here. Basically about flat here on the day, down to about 1% here. The volume here way lower than what we've seen in previous days here, though we should point out this is still the biggest volume mover in the pre-market by a factor of about 10 to 1. Also keep an eye on Progressive Corp. Interesting downgrade today over at Morgan Stanley, basically saying that as we all sort of leave the house now and start driving again, that means more accidents and that means potentially more claims for Progressive that could weigh on margins, something to keep an eye on there. And finally, just want you to keep an eye on G3 Apparel. This company, of course, licenses a lot of brands like Donna Karan, Calvin Klein, Tommy Hilfiger. They just came out with earnings, and earnings were actually good, Tom. They did well in the quarter, and they guided higher for the future.
Nice update as we stagger into the week here near record highs. Interesting to see where we'll be on Friday. This is a great joy for Bloomberg right now after the 15 years of public service at the OECD in Paris. Anil Gurria has retired. And after a really interesting nominating process, the OECD selects the Pacific Rim. The heritage of the OECD in the previous 5 secretary generals has been Denmark, Netherlands, France, Sweden, France, and then it changed to Canada and Gurria's Mexico. Now the OECD reaches across the Pacific Rim. As Kishore Mahbubani of Singapore says, it is the Asian century, and part of that is Australia. Matthias Cormann is the OECD's newly appointed Secretary General. Mr. Cormann, wonderful to have you with us today, and you dive into a treaty and the complexities of a G7 effort to tax the larger companies. A treaty makes it very, very difficult as well. How will the OECD monitor and study the treaty effort to make taxes uniform at 15%?
Well, firstly, good to be here. Secondly, the globalization and the digitalization of our economies has created distortions and inequities when it comes to the capacity of governments around the world to raise the necessary revenue to fund the public services and supports that they provide to their populations. And the only way you can solve a challenge like this is through a global solution that is multilaterally agreed. And in that context, the OECD has been working for many years to help improve the global taxation arrangements, to make them fairer, to make them work better. Now, at the G7 on the weekend, a landmark historic agreement was reached, and that goes to two important components. One, to ensure that digital companies, large digital companies, but also other large companies that operate multinationally around the world pay their fair share of tax in markets where they generate significant profits. And secondly, to ensure that multinational companies are not able to structure their tax liabilities, seriously minimize or completely eliminate their tax liabilities anywhere around the world, taking advantage of tax havens and so on. And so, ultimately, this is one step in the process. There will be other steps to follow. The OECD facilitates a process that is called the Inclusive Framework, which brings together 139 countries and jurisdictions from all around the world. And of course, ultimately, at the G20, a further formal agreement will have to be reached. But the fact that G7 economies